Hi, I'm Phyllis Rector, and this time we're going to talk about using credit cards to finance your business. Now, this is kind of interesting. There was a recent survey that showed that 15% of all credit and debit card transactions are transactions on small business owners' cards, on business credit cards for small businesses, and business owners, where business owners are guaranteeing the credit. So this doesn't mean on the, Cisco corporate credit card, Cisco Visa credit card, okay? This is small business owned, 15%. Now that isn't even counting all the credit card, all the purchases that you make on your credit card that finance your business that you may do on your personal card, okay? So sometimes using your business credit card and running up those debit balances really is the only way that you can finance your business, and sometimes that's particularly true for businesses who have consumers as their customers, where they wouldn't be able to find factoring companies, because factors don't finance businesses who sell to consumers. Okay, so sometimes using your credit card is the only option. But I want to make a couple of points here. So hopefully you know that the Congress has passed this. I think it's called something to the effect of the Credit Card Accountability Act. So first of all, that only affects personal cards. It does not affect business cards. So all the issues about raising fees and giving you more notice and all that kind of stuff is only on the consumer side. There is a movement afoot, however, to institute those same kinds of rules and regulations on business cards. And if that happens, I just want to bring up the possibility to you that that might restrict your business credit, okay? Just the way that we have seen home equity lines being frozen, or your line of credit on your company with the bank being termed out. That means instead of having a line of credit, they made it a loan with monthly principal and interest payments instead of just paying interest and leaving the principal to roll over. Credit cards, both consumer and business credit cards, have had their lines cut. So if you're not using the line, they'll say, well, you don't need it. Those open lines are potential liabilities for the bank. So basically it's going to go against their capital hit in terms of qualifying for with the regulators, as I mentioned in a previous thing. So it could tend to restrict credit. I just want to bring this up to you. The other thing is that if you're carrying a balance on your card, keep in mind that when you're making those payments, the credit card companies are going to apply the payment that you make to interest first. After all, they do want to have you continue to accrue interest on the principal amount. So that's how they make money, is by charging you interest. Okay, so just to point out, it might make a difference if you are in the position and you have business customers and you're using your credit cards to finance your business. You might want to take a look at whether paying off those credit cards, doing some spot factoring might make sense for you. When we get a partial payment, if that were to happen, we actually apply it to principal first, not to the fees that are being charged. So in that case, if you have less principal outstanding, then you're going to be generating a smaller fee on the remainder time for that invoice to be paid off. You need to do the math to see whether that works for you. Give me a call if you want some help. And it's been nice to visit with you today. Have a great day.